On Friday, the House of Representatives saw the introduction of a host of new bills aimed at reining in large tech companies. And they did that in a number of different ways, including try to propose divestment of certain assets. Sinan Aral is joining us now. He has paid a lot of attention to these issues. He's the author of The Hype Machine about social media companies. He's also the David Austin Professor of Management at the MIT Sloan School of Management. It's good to see you, Sinan. So, we've had this conversation a number of times, right, about Congress's attempts to rein in big tech, and so far, their inability to do so. Do any of these bills get closer to being better targeted at all of these big questions?
Well, I think these are important steps forward. We'll see whether these are passed and made into legislation. Obviously, they have bipartisan support. There are some Republican signatories to these bills. 5 different bills. One of them is about not being able to favor your own products and services if you run the platform or the market that sells them. Another one raises the bar to prove that a merger isn't anti-competitive. Another one increases fees for mergers to fund enforcement. These are all important steps forward and hopefully will open the door to creating more competition and innovation in the social economy and in the digital economy.
Sinan, under what is being proposed, does big tech have to spin off or sell off any key assets?
No, not yet. So there is a bill that makes it easier to break up a company if there's what is called a conflict of interest. But I don't think that this is necessary, and I don't even think that this is going to sort of result in major divestitures of these assets. I think that what we actually need to create competition and innovation is structural reform of these economies, and that's really what these bills are aimed at. However, I think there's a glaring lack of a focus on interoperability legislation, which is a big miss. I think if we had that, it would be probably the #1 best alternative to create innovation and competition, especially in the social media economy for Facebook and the others. But these are important steps forward. It signals a change from what used to be a very pro-business stance on competition and anti-monopoly over the last 30 years in the Chicago School. And I think that it's important to create competition and innovation.
So I think I could guess at what exactly that interoperability kind of dynamic you're talking about is, but I'd love if you could just outline for us a little bit of what that means for users, normal people as they think about their use of these platforms and what that would look like if some of these, kind of ideas came through.
Yeah, interoperability just means that I can use one service with the other. So I can imagine if you couldn't send a text message from Verizon to Sprint. You would think that's ridiculous, but right now we can't send messages from Facebook to Twitter or from Instagram to Snapchat, and that creates more ability for monopolies to retain their power. If there was interoperability, it would create competition. When we had the AOL Time Warner merger, AOL Instant Messenger was forced to become interoperable with Yahoo Messenger and MSN. It went from 59% market share the year the legislation was enacted to 55%, and then it ceded the entire market to new entrants 3 years later. What would this look like? Well, right now, all of the platforms have very similar messaging protocols. You have fleets and stories, you have text-based messaging, you have video-based messaging. It would just mean that you could send messages from one platform to another, and the critical thing that enables is choice. I can then choose which platform I want to be on to send messages to any other platform. That's where the competition comes from.
And Sinan, I'm guessing you would also be in favor of sort of opening up the App Store, which has been something that, of course, has been in focus for Apple in various quarters, that they should maybe not make it as onerous as critics have said it is to put stuff on the App Store to not advantage certain things, et cetera.
In this digital age, things like the App Store are a massive part of commerce. And I like what Elizabeth Warren said about this. You can't be the umpire and a team in the same game. I shouldn't be able to set the rules of competition and then compete by providing my own products and services while giving preferential treatment, say, to Amazon Basic products or to Apple apps in the App Store. And I think it should be a little bit easier and less financially onerous to be part of the competitive landscape on a digital marketplace like the App Store or on Amazon. That would create opportunities for small and medium-sized businesses to compete. That would generate competition. It would generate innovation. All of that would be good for the entire economy.
Finally, Sinan, I do want to ask you about another story that came out in the past week that I wonder if you have a view on. And it has to do with the release of subpoenaed information from the US government. In this case, Apple releasing some personal information that was subpoenaed. And it turns out it was for members of Congress and other folks that were high profile. So this is it's a tricky situation for these tech companies. How do you think that kind of situation should be approached?
These subpoenas should never have been issued, is my opinion on that. I think that there was a tremendous amount of government overreach in trying to investigate and infiltrate, Don McGahn and other types of lawyers for the White House and other, political officials and so on. This is not something that you expect to see in the United States. This is something that you might cringe at if you saw it in another country. And I think that, my basic position is that these subpoenas shouldn't have been issued in the first place.
Fair enough. All right, Sinan, great to see you as always. We'll talk to you soon. Sinan Aral, author of The Hype Machine and a professor, the David Austin Professor of Management at the MIT School of Management.
Next generation GPS maker NextNav plans to be a public company before year end after saying it will combine in a new SPAC transaction. Founded in 2007, NextNav is being valued at $1.2 billion. The company's technology is believed to help locate a device's specific indoor positioning. Let's welcome in NextNav Chairman Gary Parsons. It should also be noted, Gary's also the founder of XM Satellite Radio. Gary, good to see you this morning. So not a new company, unlike a lot of the other SPACs that have come to market. You've been around since 2007. Yeah. How much business will you do this year, and where is it coming from?
Well, it's interesting. Yes, we're not a new company. We've been developing this technology for over a decade. Frankly, we put together the Spectrum asset that we're building this next generational GPS capability off of back even further than a decade. But we've had to roll it out, get it accepted as an international standard for GPS or a terrestrial-based GPS system. And the advantage of that, obviously, is that, it goes deep inside buildings. It's not as weak. It can't be jammed easily. It can't be spoofed to make it appear you're in some different location. So it overcomes all of the frailties that GPS has historically had. That's where it's coming from. Our initial customer, our initial partner is AT&T and the FirstNet Authority, the national broadband technology for first responders. And, your graphic leading into this was, tracking people inside buildings. But, actually first responders and a SWAT team needs to know where their people are for situational awareness. So that's one of the first market opportunities. And obviously gaming very much utilizes knowing exactly where you are, a Pokemon Go, but also vertical, so it can go different places within cities. Advertising, the mobile advertising and data analytics, the ability to determine foot traffic for a particular shop in a mall, where there's a very different retail outlet on the first floor, second floor, third floor. So all of those are positive aspects. The often overlooked and aspect that was one of the things that got me involved in wanting to do it for a public safety and actually national security issue is the fact that it provides a GPS-like backup timing. And if you're familiar with it, most critical infrastructure in the United States, all the cellular networks, the power grid, financial transactions, they all actually get their timing or clocking off of the GPS system. So it not only from a consumer standpoint or for first responders allows you to know exactly where you're located within a building in an emergency situation, but it also allows in the event of hostile actions to damage the GPS system, or frankly, even a massive solar flare or something that disrupts the satellite systems. You've got so much commerce in the United States today. It's estimated by the U.S. government over $700 billion of economic activity is keyed to GPS. Some of that to its location aspects, some of it's to its timing aspects. But for the last 10 years, we've been developing the product, rolling out the network with our partner AT&T and FirstNet to get it in the hands of the first responder community to save lives and give situational awareness to the first responders.
Hi, Gary, it's Julie here. So you've talked a lot about the potential for this. And of course, we showed some of your revenue projections on the screen, but I guess I'm curious, where is it actually being used today? Or do you know sort of by the end of the year who's signed contracts with you to put this into use and to see some of those use cases that you've talked about come to fruition?
Julie, it's probably good to separate it into two discrete separate products. One, our Pinnacle product is actually the element that adds the vertical location to existing horizontal location networks. So whether it's a Wi-Fi network or a GPS network, now the blue dot, instead of just moving horizontally, can go up in a building. We only introduced that product commercially just a couple of months ago. So as you can imagine, it is the earliest stages of adoption. AT&T and FirstNet, as we indicated, are our first customers. It's being used by first responders today for their own situational awareness. But we're also have signed agreements with Gimbal, who supports 1,800 different apps and applications, Panera Bread app, things of this. They do in-stadium apps to help you find the location where you go to get your nearest beer. And by doing this, they can using our precise location capabilities, they're able to give you the best direction. The second product that is probably 2 more years away from widespread adoption is the one that provides the GPS backup capability for critical infrastructure. But that's also what provides the certainty and resilience of a signal for GPS for autonomous vehicles, eVTOLs, UAVs, drones, all of those things that have to have a secure location capability. It can't be blocked by a building as soon as you get into a city or jammed, by a signal. So that's our first customers today. Unity and the Unreal Engine from Epic Games are 2 of the biggest gaming groups that have signed agreements with us, so that you can now provide 3D and augmented reality capabilities to all of their gaming capabilities as well.
Gary, before we let you go, SPACs have gotten really a bad rub in recent months, and in many respects, rightfully so. What type of financial rigor have you brought to the company, and have you built into the company?
Well, I mean, the first thing to kind of understand is both it was a different SPAC that we engaged with. We didn't go through some SPAC off just to get the maximum valuation. We wanted people that knew the industry, that we knew them, they knew us. I go back decades with some of those investors. And then secondly, we've put over $250 million into this company over the last 10 years, from Goldman Sachs, NEA, Oak, Future Fund, Columbia Capital, some of the biggest names and strongest long-term players in the venture capital world. So, we've always had a view for the long term on this. And we think that's an important element to have that stability. But now, as we're getting to finalize rolling out the TerraPoint network to provide that critical GPS capability, and I would mention, by the way, Brian, we don't have any money in our plan from federal government support. But clearly, this is a huge activity at Congress. It's actually one of the few bipartisan things you're ever going to find. To have Ted Cruz and Ed Markey as the lead sponsors on this are about as diametrically opposed as you can get. But they all recognize the vulnerability for national security. And so we think infrastructure bill-wise, we're likely to get some support out of that as well, too.
Let's bring in our first guest for the hour. We've got Josh Lipsky, Atlantic Council's GeoEconomics Center Director. And Josh, you heard Brian there say, is it time to talking about tapering? What do you expect from the Fed this time around?
Right. So in that dichotomy Brian brought up, I'd say I'm on team transitory. And I think most of the Fed governors are still there. And of course, this idea that are they going to talking about it? They're always thinking about it. And the real question is Powell going to blink at this meeting? And is there going to be some language shift that people are looking for when it comes to tapering? And I think the answer is no. And we can think about the G7 central bank governors meeting that happened 2 weeks ago. They were all together in the room. They were thinking about these issues together. Christine Lagarde at the ECB came out of that. She said last week, they're not changing their policy. I think the Fed is going to do something similar this week. And it's really Jackson Hole in August when we're going to start seeing the shift in language. So I think it's steady as she goes. Let's see what happens over the summer. Let's move through some of these base effects that are really distorting the numbers. Let's see how permanent some of these supply chains issues can be. And then let's get to Jackson Hole and maybe start telegraphing a tapering process.
Yeah, and Josh, I wonder if it's more, kind of the global state of things right now that might be helping the Fed work through taking a little bit more time to get there, or whether or not their policy, proposals and the way they've been framing all this has worked in convincing the public that the inflation data that we've been getting is just transitory. I mean, when you look at that, and as Akiko points out, the 10-year yield at 1.5, talk to me about how they've been successful in maybe getting people to buy in.
The Fed's been extraordinarily successful in their narrative. They've been consistent, and that's another reason why I don't think Powell is going to break too soon with it. Already we actually see some of the inflation expectations coming down from where they were just a few weeks ago. So that's a credit to the Fed by saying we believe this is transitory and people agreeing with that. And so we're seeing some of that filter into the market. So all of that plus the base effects, I think it's the US situation that the Fed's looking at primarily, of course. And then there's the other issue that Powell talks about so much. 8.5, 9 million unemployed. We don't talk about it as much, but this Fed talks about it a lot. And that weighs heavily on these governors. You saw Governor Brainerd talk about that recently. That's part of the Fed's dual mandate as well. So when you take it all together, take in some of this reversal in inflation expectations, I would be surprised in a signal in tapering right now. Doesn't mean the Fed doesn't need to do it. The economy is still running pretty hot going forward, and you don't need 120 billion a month in perpetuity. But this is too soon, in my opinion.
Josh, I wonder how you're looking at this from a global picture. Obviously, you look at central banks around the world pouring in enormous amounts of stimulus over the last year. Your former boss, Christine Lagarde, talking about how she thinks some of these temporary factors could start to fade out by the end of the year. Which one of these big banks or big central banks do you think moves first?
Well, all eyes still on the Fed, right? I mean, everyone wants to see what the Fed does, and the pressures are hottest in the U.S. And they're a little different in the Eurozone, where we haven't seen the kind of stimulus we saw here. And they've taken extraordinary monetary policy action, but not the same on fiscal. So I still think it's going to be the Fed. And again, I do think it's going to be Jackson Hole. And think about the symmetry of that, right, Akiko? Because it was 2 years ago at Jackson Hole where Powell outlined the new framework. And he said, we want to get sustained above 2%. And everyone said, really? Let's see what happens when push comes to shove. And then it's like a baseball game. You get into the game and the ball finds you right away. Sure enough, the crisis hit and the Fed's hypothesis got tested. So I think it's the Fed that moves first, maybe the Bank of England in September as well. But I think it's the Fed signaling in August and then ECB, Bank of England in September. That's what I see as kind of this back to school moment when we get to the end of the summer.
Yeah, and I mean, we also, I guess, have the benefit of seeing vaccinations working here in the U.S. as we saw the UK kind of extend their deadline here for reversing their lockdown measures. And when you look at that, I mean, how important is that on the global perspective when you think about what we saw out of the G7 meeting here, not just in terms of, boosting vaccine doses around the globe to kind of help this recovery globally, but also the way that they've been approaching taxes and what Treasury Secretary Janet Yellen has been trying to do there to get these countries to work together. How much progress is being made on that front relative to what we saw in kind of the nationalistic stance that President Trump took?
Yeah, if you think about the G7, both the finance ministers and then the leaders, two headlines for me, shots and taxes. And those are two pretty big deliverables. And shots is an economic story as much as it is a health story. And the IMF's been very clear about this. The amount of GDP growth the world could see if we got the vaccine distributed more quickly. Believe me, that was part of the G7 conversation happening this past weekend. They made some progress, probably not enough. And the variants are always worrying. And any of this can sort of make people pause and reverse where they are. Certainly that's true in the UK right now as we track the Delta variant. But I do think what they saw both on the shots issue and then on the taxes was we can make progress together. It is a bit of a return to multilateralism. And 6 months ago, when Yellen announced the global corporate minimum tax as a key agenda, a lot of people said it won't be possible. This has, been talked about forever. And granted, the G7 is just one small step in a broader conversation that has to include the G20 and the OECD, but it's a significant step. And if they get those billion vaccines out there and they get at the G20 in July an agreement on global corporate minimum tax and get China on board, big ifs all around. Wow, that's a pretty big 6 months from a global economic perspective.
Josh, the other headline coming out of the G7 summit as well as the NATO summit yesterday is this collective response to China. You've got this counter to the Belt and Road, this initiative that's been announced. You've also got this tech council that the U.S. and EU has said they're going to establish to ramp up R&D collectively. I mean, how much of that really changes the dynamic with China in countering their influence globally? Has anything fundamentally changed as a result of these announcements that came out over the weekend?
Yeah, it's a great question. So the answer is not yet. And, was a lot to that announcement, Build Back Better for the World. People have been waiting for a long time to see a counter to Belt and Road. But let's think about this for a second. Belt and Road has a 10-year head start. Projects all over the world, including, by the way, in a G7 country, Italy, which is probably why some of that language might have been even more watered down. So it was a good announcement, but a lot of questions remain of how much money is going into it, who's funding it, what projects will be funded, and China is well on its way in terms of their infrastructure projects. So there's a lot of catch up to do if Build Back Better for the World is going to be a real rival to Belt and Road. And on the Tech Council, same thing. Great idea, needs to be done, but the US needs to pass its own China Innovation Act first before it can come to the table and say, this is what we're doing in R&D, let's match it and collaborate with the Europeans. So, on both of those issues, on Belt and Road and on the Tech Council, good announcements, but let's see where we are at the next G7. That'll be the test for me if these things are actually in action.
On that initiative, B3W for short, is what they're calling that Build Back Better. Where's the battleground? Is it in Africa? Is it in other developing regions? Where should we be looking to see if the U.S. along with its allies is in fact making some progress to counter Belt and Road?
It's everywhere. It's such a great question. There's no one battlefield. You can look at other parts of Asia, China's neighbors. You can look at sub-Saharan Africa, but you can even look at Europe, Italy. As I said, Belt and Road is everywhere. And it's also in Latin America. So, the idea that, where we can counter it first, it has to be countered everywhere. And what I think you're going to see happen is actually Japan diving into this and being a leader here. I think they have the most to gain being in the region. I think they're going to want to invest in this heavily. And that would be a pretty significant statement. So I see it first in Asia being the immediate counter, but you also have to deal in places in your backyard in Europe and Italy.
And Japan's got the Olympics, too. A very busy year for them, potentially, if they also get on board with that. But Josh Lipsky, Atlantic Council GeoEconomics Center Director, appreciate you taking the time to chat with us. Welcome back. As we've been covering, more and more restaurants are having to get creative with keeping and retaining talent as the business starts to come back. When we look at restaurants, fast casual, of course, has also been enjoying an uptick here, both pre-pandemic and post-pandemic. And Chipotle is among those latest, passing some of the increases in terms of wages being paid to workers along to customers, as the company said it will be raising its menu prices by about 4% due to increased wages. And it's raising a couple questions now about what other restaurants might follow in doing so and what it means for the company itself. And for more on that, I want to bring on Peter Saleh, BTIG Restaurant Analyst, here back with us. And Peter, when we look at this, You actually have a price target of $17.25 on Chipotle, noting about 25% upside there. Talk to me about how pricing power and really teasing out winners and losers here, if they are going to be paying workers more, becomes important, and maybe why that could be a plus here for Chipotle.
Yeah, so thanks for having me on. Look, I think the labor shortage is an industry-wide problem, and it doesn't seem to be going away anytime soon. And I think you're going to see, yes, Chipotle is one of the few that has announced a price increase and being more aggressive to try and offset some of the margin pressure from having to raise wages. But while they're the ones who have actually announced it, the rest of the industry is moving in the same direction, we believe as well. You're going to just see more and more price increases to offset this. There is a pretty severe labor shortage. I was talking to a management team, not Chipotle's, but another management team a few weeks ago, and they were saying they were part of a job fair out in Michigan where there were 60 other companies involved looking to fill 500 positions, and they only had 4 candidates show up. So there is a severe labor shortage, and until that's resolved, I think you're going to see this battle for employees, and the only way to really make them happy is to pay up and give them more benefits.
So, Peter, I wonder how this sets things up, at least in the medium term, because we have heard over and over, especially from lawmakers who've said that, look, the reason there is a shortage right now is because of these enhanced unemployment benefits, which are set to expire, but largely because some workers simply don't want to return to work. And yet we had a conversation yesterday with one company who works very closely with a lot of these food outlets who said he doesn't think that has anything to do with the benefits, that employees just simply have more leverage right now because the demand is so high from them. How did this set things up for some of the big players like a McDonald's as well as a Chipotle that you cover?
Yeah, several weeks ago, we hosted a restaurant called Tech Forum, and we had several executives that opined on this exact issue. And I don't think everybody's in agreement that that is the core issue, this unemployment benefits. I think many believe that workers just want more flexibility. They want more, work-life balance. They don't want the overtime as much. So I think there's a shift in the trend. Clearly, employees want to get paid more and they want more benefits. But I'm not exactly sure how much of an impact the higher unemployment is really making here. I think it's more just employee psyche and what they're really looking for. I think that's really what's driving this. And it does not seem to me like this is a short-term issue. I think this is more of a long-term problem that the restaurant industry and really anybody employing hourly employees is going to have to deal with.
Yeah, I used to work in the industry as well. Back when I was in high school, it was a good job at a Z Pizza, if I can shout them out. But when we talk about, how this is going to set up winners and losers, last time we spoke, you were talking about a franchise mix and the way that that's going to be important to watch here. But when it comes to maybe some of those on the value side, I assume they would be more, more pressured here if they were to raise prices to suffer the consequences. Talk to me about how you're breaking down winners and losers if we are to expect this to hit menu prices in the future.
Yeah, look, I think the larger brands that are more sophisticated and that can move quicker to hire employees, I think those win. I feel like the independents, the mom and pops are going to struggle. I feel like the larger brands have opportunities to increase benefits and provide promotion opportunities and attract employees. So in my opinion, it comes back to the larger brands. It's not necessarily, whether you're value or you're higher end. I think they're all going to struggle and they'll all have to raise menu prices. To me, this is more about how big of a brand are you, a recognized brand versus an independent mom and pop. My guess is that the larger brands have more resources and more ways to attract those employees versus the independents and mom and pops, which really make up about 50% of the overall category.
So if we're talking higher or better benefits, higher wages, that seems to suggest higher costs overall. Chipotle's already raised their prices. Who's likely to follow, and who do you think is best positioned to take the hit, if you will?
So if you look across the restaurant industry past 5, even 10 years, I think the average menu price increase has been somewhere around 2.5% every year. My guess is this year will be outsized. We might be 3%, if not higher, to offset some of these labor pressures, because we're also getting commodity inflation as well. Look, I think you're going to see it across the board from every operator. I think the operators who have taken less price in the past probably have a little bit more that they can take now. Operators like Darden with Olive Garden, they've taken less pricing. I think Chipotle has, in my opinion, probably been a little bit more of a value on the plate to the consumer. They probably have a little bit more opportunities. But you look across the industry, everybody's going to be raising prices, whether it's 2.5%, 3%, 3.5%. Prices are going higher, and you're just going to see more inflation. There's really no other solution other than implementing more tech, which can help offset a little bit of these price pressures.
Yeah, Chipotle at 4%, the first one we're discussing here, but clearly a conversation we're going to return to. Peter Saleh, BTIG Restaurant Analyst, appreciate you joining us.
Well, our next guest says that he has diamond hands and has partnered up with BlockFi to encourage others to invest in and earn interest from cryptocurrency. We're joined now by former Bachelor star and partner with BlockFi, Matt James. So Matt, let's just start here. Because cryptocurrency is an incredibly volatile asset, there's a lot of potential for people to lose quite a bit of money. Why do you want to promote folks get invested in and get involved in cryptocurrencies? Where's the appeal to you?
Well, thank you for having me, Kristen. And I think that the appeal is the adaptation that we're seeing taking place. And it's no longer something that is not being taken serious. You have major institutions who are allocating major chunks of their portfolio. You have hedge fund managers like Paul Tudor Jones, who's advising people to put at least 5% of their portfolio into it to hedge against inflation. And 5% might not seem like a lot, but when you're a billionaire, 5% is a lot. So I don't think it's a matter of if, it's a matter of when now. And I'd like to be on the right side, and partnering with the BlockFi helps lead that charge in educating underserved communities so that they don't miss out on this wave that it can be extremely lucrative.
So Matt, talk to us a little bit about your investing philosophy. Do you hold cryptocurrency? If so, what do you hold? And just are you one of those folks who likes to sort of buy and hold for the long term? Are you a little risky? Share it with us.
I would consider myself a Bitcoin maximalist, and I haven't sold anything that I bought in through the dip. Fortunately, I had a little bit of cash reserve, and I was able to load up on what some people were trying to get rid of. But my philosophy is, and I don't see it changing, is a hedge against inflation. And it doesn't look like the Fed's planning on raising interest rates anytime soon. So I just want to make sure that my money is worth more in the future. And one of the seamless ways of doing that is investing in an asset that is trending in the right direction and there's a limited supply of. It's a very simple view for me, and it's a very simple strategy. Just buy Bitcoin and hold.
So is it just Bitcoin that has captured your attention and your interest? I mean, there's more than 5,000 cryptocurrencies out there right now, or are you looking at some others, perhaps Ethereum and maybe even Dogecoin? I have to ask you about it.
Kristen, for my investing goals and financial plans is strictly, again, a hedge against inflation and protecting my wealth long term. And in doing so, the best digital asset for me to put that in would be Bitcoin. Not saying that there's not utility value in owning Ethereum and having a diverse set of altcoins in your portfolio, but for my personal investment and strategy going forward, it's to be in an asset like Bitcoin. And that's why it makes sense to work with a BlockFi. I can literally earn Bitcoin by holding my Bitcoin, which is what I was going to do anyways. And then with their credit card, I get Bitcoin reward by spending money that I would be spending anyway. So it was very seamless in terms of wanting to work with a company that had the same financial vision that I have, as well as similar views. You know, they're co-founded by a woman, happens to be diverse as well. And it plays into the story that we try to tell our students that we work with in these underserved communities. And that's really in doing your own research. And to answer your question earlier about just being invested in crypto in general, I'm not advising anybody to put their life saving into it, but what we're doing actively is educating people on this space, where it's going and how they can get involved. So
all right. So Matt, I want to ask you about the Bachelor franchise. And of course, you made history on the show being the first Black Bachelor. I know you worked with Chris Harrison, who was host of the show for 19 years. He recently exited after he had, I guess, backed up Rachel Kirkconnell after those racially insensitive social media post. Back when this was all going down, I know you actually went on the record as saying that you didn't think Chris should be let go and that you didn't think he should be part of sort of the cancel culture. Now that he's gone from the show, have your feelings changed at all about that?
You know, I'll tell you this, Alexis. One thing that I learned from the show is that when you have something good and you see something good in your life, you got to hold on to it. And similar to how I took that into my personal relationship advice, I also take that same advice in holding Bitcoin. And as you saw in the dip, I wasn't one who was selling, I was holding, and I'm going to continue to hold and ride this wave out because I have long-term views on my relationship as well as I do on Bitcoin.
All right, that was an artful pivot. I will give you that. Matt, I do want to ask you, in terms of getting paid going forward, would you ever try to get paid in cryptocurrency? I know you used to play football. This is something that a lot of NFL players have actually been talking about lately, getting paid in Bitcoin. Is this something that you're talking about or wanting to be a part of your contracts, your business contracts moving forward?
I would advise people to do their research because when you're dealing with things that are volatile, you're going to have price swings. And if you don't have a long-term trajectory on Bitcoin, then you could be flustered when you see price going up and down in the near term. But if you have eyes towards the future, then I think it would make sense to be paid in a currency that's going to outperform the dollar going forward. I love it. I love what Trevor Lawrence is doing. I love what a handful of athletes are doing their due diligence in, and that's preparing for the future. And if I was still playing sports, I would definitely want a portion, if not all of my contract to be in the form of Bitcoin as well. So hats off to those guys for being trendsetters. And I look forward to seeing men and women in those fields continue to leverage everything that's taken place in the space.
Matt, before we let you go, we all want to know, have you talked to Chris since he left the show? I know he was looking for a $25 million payout. We don't know what he got. He came to some sort of an agreement, but have you guys talked?
You know, what I would say is that the smartest thing that could be done with any of the payout would be to buy as much Bitcoin as possible, because right now it's at an all-time low. If you're looking at the past few months, and I'm hoping that, you know, if you're wise with any of your investments, you can, you're looking to double that money if you see it going to the moon like I do and reaching over 100,000 by the end of the year. So not financial advice.
So your advice to Chris Harrison is to take whatever money he got from ABC and put it into Bitcoin on BlockFi?
I'm saying I think that anybody who comes into a large amount of money should at least consider looking at the asset class because of where it's gone, where it's trending, and what the future looks like, taking into account inflation.
All right, Matt James, former Bachelor star, partner with BlockFi. Thanks so much for joining us today.
as we've been watching kind of this back and forth in Washington, D.C., as we've had Republicans sign on to the idea that we could meet in the middle there, that $1 trillion proposal, which kind of sheds out some of the more progressive pushes there when it comes to climate change, specifically a lot which was included in President Biden's original stance. Of course, the proposal would take Democrats buying into the idea of compromise. And for more on that, I want to bring on a Democratic senator from New Mexico. Senator Martin Heinrich joins us right now for more on that push. And Senator, you kind of put it bluntly in your tweet about this compromise and meeting in the middle, saying that you shouldn't count on every Democratic vote to want to agree to this compromise because it doesn't go far enough on climate. We heard Senator Ed Markey, your comrade from Massachusetts there, putting it even simpler, no climate, no deal. So what do you want to see, and what's the workaround here maybe for Democrats if this proposal is where the bulk of the party wants to go?
Well, I think the question is the deal an infrastructure bill as outlined by this group, plus additional climate measures through reconciliation, or is this the only game in town? And we are at a moment where we really have to be making major investments in solving the climate crisis. We are out of time. We need to show leadership on the world stage in the run up to Glasgow to be taken seriously. And we need to begin that transition now. So if those investments are simply left out, I think that's a hard sell.
So, Senator, let's walk through some of those provisions that were in the original proposal from the president. You had the 500,000 charging stations, an update to the country's electric grid. You had additional money to help fossil fuel workers transition into the green economy.
Exactly.
I mean, there is a long list here, and I wonder which one of those you're willing to part with right now to get a little closer to a deal with Republicans.
So it's not my position that we need everything in the American Jobs Plan to get to yes, but if the package as a whole simply doesn't make the kind of scale of change that we're going to need to be able to address this crisis, then I think it simply doesn't meet the moment. There's no clean energy standard in this package. The investments in electric vehicles, we're hearing that it may actually make owning electric vehicles even more expensive instead of moving it in the right direction. So, I do believe we have to look at this in its totality, but we have to meet the moment. This is our time to do something about climate. The president certainly sold that on the campaign trail and incorporated those priorities into the American Jobs Plan. And I don't think it would be acceptable to most of the people who really embraced that agenda to simply walk away from climate.
You hinted at another alternative here, Senator, which is to sort of meet the Republicans on the infrastructure bill, but then have a completely different bill on some of these clean climate goals that could be passed through reconciliation. Has that ball already started? Have you already started the discussions on that front? And if you do move in that direction, do you have enough support on the Democratic side?
Well, I think that the likely path here is either these things will move in parallel, knowing that we have the votes to pass both, or we may not see either of them move past the Senate floor. So those are ongoing negotiations. And at the end of the day, my biggest concern is at a time when the West is on fire, when we have no water in our reservoirs, when people are really suffering directly from the kind of climate change aridification, not drought, but like long-term aridification, this is the time when we should be meeting that challenge, meeting that crisis, and not turning away from it.
Yeah, let me flip Akiko's question on the other side here too. I mean, if you were to point to some of those things that could potentially be left out, if this compromise is the way that it goes, what is one of those things that you say we just can't do without when it comes to the climate push here? Because there are a lot of things that would seemingly be left out if that's what we're going to see here.
Well, I think we've learned how to do these changes and manage transitions well, and we also know how to do them poorly. And really making sure that we take care of the people who have worked in our traditional energy industries is incredibly important. A clean energy standard would be incredibly important to move the dial on actual emissions. And if we're going to transition to an electric future, we have to have charging stations. So I think making it more expensive to own a new, Ford F-150 Lightning is a bad idea. So we have some work to do here.
Senator, we saw a lot of lawmakers responding to comments that climate advisor Gina McCarthy gave to Politico, talking almost as if the concession had already begun, saying that we will be able to push forward in these climate goals in a different way, because increasingly it does feel like they won't all be included in the infrastructure bill. And I wonder what that conversation has been like with the White House in trying to push forward these grand ambitions that they really highlighted in the first few months of this administration.
Yeah, I wouldn't use the word grand ambition. This is necessary. This is us meeting a crisis that is impacting our economy, that is impacting our culture and our country. Fortunately, I think the White House walked back those statements really quickly, knowing full well how important a clean energy standard is to getting where we need to go. And I simply, feel that this is a moment when we have to meet these challenges, because failure is simply not an option.
Yeah, and just to go back to the reconciliation path there, I mean, it does seem like it's one of those things where you might lose the enthusiasm that you need, mainly among moderate Democrats there. And I'm thinking about Joe Manchin when we think about how he might operate in the idea of not wanting to go with the reconciliation pathway. Again, we've heard him kind of push back against that strategy here. How important would it be then maybe potentially to lose support among those Democrats specifically if that's the way this all shakes out?
Well, you need everyone's vote. So just as Joe Manchin needs my vote for passing an infrastructure plan, we're going to need his vote for reconciliation. And there needs to be a willingness on both sides to come to a resolution here. And I think we're really going to need leadership from the White House, from the president in particular, to be able to hammer out what that path looks like. But once again, I'll say that, ignoring climate change at this moment in time, that's simply not an option.
Senator, you just alluded earlier to this heat wave that's engulfing the West. Obviously, in New Mexico, looking at record temperatures. But we've also got these numbers coming out of places like Phoenix, a record 115 degrees, Palm Springs over in California at 120 degrees, and we're still in the month of June. As you look to your home state right now and how you cope with the record heat at a time when you're already experiencing drought, what are some of the solutions you're looking at? What are you hearing?
We're, investment in infrastructure is a big part of those solutions, and in particular, managing our water resources better. And that is something that I believe ought to be included in this infrastructure conversation, as well as, beginning the process of really ramping up the complete decarbonization of the economy. We've historically tended to just think about the electric sector. And if we're going to meet these challenges in a time frame that gives our kids a chance at the kind of lives that we've had, then we need to address decarbonizing the transportation sector of the economy, decarbonizing heavy industry, decarbonizing agriculture. And these sort of 1990s half measures just don't get us there.
On the issue of electrification, you've introduced this resolution to try and provide incentives to switch over from natural gas, especially in home appliances, machines. I mean, this is something that has become quite a contentious issue. And I wonder what kind of incentives you're looking at. What will it take for consumers and as well as builders to switch over? And how much of that is the federal government's role versus local governments, especially the state?
Well, I think creating those incentives that just simply remove the friction so that you can make a long-term economic decision instead of a short-term economic decision. And what I mean by that is if you're going to switch out a hot water heater from from a gas-fired hot water heater to an electric heat pump water heater, there's an upfront cost associated with that, but then there's a much lower month by month energy cost. And so if you can create the financing structures to make sure that people are acting in their long-term economic interest, then you can really incentivize a much quicker adoption of many of these technologies, technologies which also save lives, because we're learning a lot about indoor air quality, the risks associated with gas stoves and with combusting gas in enclosed spaces. And so I think we do have a role in making sure that people can act in their own long-term economic interest, instead of feeling like, well, the hot water heater went out yesterday, so I have to take whatever's available and get it in right away.
Yeah, there's a lot of issues at hand here, and one that we've been watching as these back and forths continue. We'll see how it all shakes out, but thank you for taking the time here to chat with Senator Martin Heinrich from the state of New Mexico. Thanks again.